a comprehensive guide for investors. Introduction. So, let's say you want to get started with this investing thing. You might have a bit of money saved. It's probably not enough for a house, but you decide you should probably invest it in something. You could invest in stocks, shares, equities, government bonds, corporate bonds, real estate, foreign exchange, crypto, NFTs, futures, fine art, or watches. There seems to be tons of stuff out there. You might have even seen those ads on YouTube from the gurus talking about day trading and trading foreign exchange and how you could make money in that way through investing. On top of all of this confusion, there's the very real fear that you might lose all of that money that you've worked so hard to save up. So, in light of all of that, this is the ultimate guide to investing for beginners. And we're going to split this video up into 4 parts, which are going to be timestamped down below so you can skip around if you feel like it. Part 1 is going to be about the basics and the philosophy behind investing. Part 2 is about why and how to invest your money in stocks and shares. Part 3 will address common fears, questions, and concerns about investing, like what if I lose all my money? Part 4 will cover Fastlane investing, which is an alternative approach to the traditional investing method to build wealth. Part 1. Basics of investing. The philosophy and basics of investing. Let's start by talking about the point of investing. The point of investing is for your money to be able to make more money. For example, let's say you start off with $1,000 that you've saved up through your hard-earned labor. Now, you could put that money under your mattress or in a bank account. However, the problem with that is inflation. You might be reading about inflation in the news. So, your $1,000 might be able to buy you a MacBook Air right now, but a few years from now, when inflation goes up, that MacBook Air might cost $1,200. Over time, your money loses its purchasing power, which is why you ideally want to invest in something. When you invest, your money grows on its own, and that means you can combat the effects of inflation. Now you might ask, how does the money magically grow? Generally, the philosophy behind investing is that you buy something now, and that something makes you more money over time. There are 2 ways in which the thing you buy can make you more money. Let's say you buy a house. It costs a certain amount to buy the house right now, but there are 2 ways it can make you money. You can rent the house out and get rental income every month. The value of the house will hopefully rise over time. If you hadn't bought the house and just had that money sitting in a bank account, over time, you would lose money due to inflation. Houses are an interesting example because you get rental income, and it's very easy to imagine what that looks like. With most other asset classes, you don't have this equivalent of rental income. Instead, you're buying and hoping to sell them for a higher price over time. The main exception is some stocks and shares, which we'll talk about later in the video. Types of investments. There's a long list of things you can invest in: stocks, shares, and equities, hedge funds, index funds, bonds, government and corporate, watches, fine art, crypto. A lot of this can get very complicated quickly. We're going to simplify things and focus on investing in stocks and shares. This is the main type of investing that normal people like you and me can unlock fairly easily. You don't need large amounts of money, like for a house. You don't need to take on huge amounts of risk like with crypto. And you don't need to be an accredited investor for most investments in stocks and shares. Part 2. Stocks and shares. Why and how to invest in stocks and shares. When you're investing in stocks and shares, you're buying a percentage ownership in the company. For example, if you buy shares in Apple, you own a small part of Apple. You can't buy directly from Apple. You go through a middleman called a broker. There are two ways to make money from stocks and shares. Capital gains. The price of the stock rises over time, and you sell it for a profit. Dividends. Some companies, like British Telecom, pay dividends, which are a portion of the company's profits paid out to shareholders. Choosing companies to invest in. How do you choose which companies to invest in? Many opinions exist, but let's consider Warren Buffett's advice. Unless you are a financial professional, don't try to pick stocks. Instead, invest in an index fund. What is an index fund? An index fund is a fund that tracks a particular stock market index. A famous example is the S&P 500, which represents the top 500 biggest companies in the U.S. By investing in an index fund, you effectively diversify your investment across all these companies. For example, if you put $1,000 into the S&P 500, your money is split among 500 companies based on their market value. This diversification reduces risk because your investment doesn't depend on the performance of a single company. How to invest in an index fund? You can't buy an index fund directly. You need to use an investment platform. The choice of platform depends on your country. In the UK, for example, you can use Charles Stanley Direct, Vanguard, or Trading 212. Platforms like Trading 212 allow you to practice investing with virtual money. They also have features like Investment Pies, where you can copy investment strategies from other users. Part 3. Common fears, concerns, and questions. Fear of losing money. It's natural to worry about losing money. For example, if you invested $1,000 before the 2008 financial crash, your investment might have dropped to $400. However, if you held onto your investment, the market eventually recovered, and your investment would have grown. The stock market broadly goes up over time. The longer you leave your money in, the more it compounds. How much money do you need to start investing? You don't need to be super rich to start investing. The amount required varies by platform. For example, on Trading 212, you can start with as little as £5. Part 4. Fast lane investing. Alternative approach to building wealth. Traditional investing is often seen as a slow lane to wealth. You save a percentage of your paycheck, invest it, and wait decades for it to grow. An alternative approach is fast lane investing, as described in M.J. DeMarco's book, The Millionaire Fast Lane. Investing in yourself and your own business. Instead of investing in someone else's business, invest in yourself and your own business. For example, you can invest in skills that increase your earning potential. If you can use your money to develop a skill that significantly increases your income, your return on investment can be much higher than traditional investments. Investing is about making your money work for you. Whether you choose the slow lane or fast lane approach, the goal is to grow your wealth over time. Start small, educate yourself, and make informed decisions. If you found this video helpful, don't forget to hit that like button and subscribe to the channel for more insights on investing. And if you have any questions or thoughts about the capital market, drop a comment below. I'd love to hear from you.